I think it would be a difficult process for the average investor to go out there to the marketplace and say, hey, I want to find a really good investment management team. I think that would be a very, very difficult task to do. All right, and welcome in to another episode of CFP Reacts, where I, your host, Scott Schiller, certified financial planner and wealth management fiduciary, reacts to the best and worst financial planning advice in social media. And in today's episode, we're going to be diving into an age-old topic. It's a conversation that comes up quite often for me when talking about investment accounts, allocation within 401k, 403b accounts, and anytime we're talking about long-term investing in stocks, which is, do I use active mutual funds or should I just use the more popular low-cost index funds? Okay, and so this has been a debate that's been going on for many, many years within our industry. And in today's video, this one is from The Ramsey Show. We're going to be diving right into it, and the guys here are going to be giving us an explanation of their view on index funds, or should we use active management in mutual funds, okay? And so let's go ahead and jump right into it, and thank you so much for tuning in.
Great. So let's talk about index funds versus mutual funds. And for the listener's sake, if they're like, what are these goober nerds talking about? Index funds are basically passively managed mutual funds. So still a giant group of stocks, but it's tracking an index, basically a set list of companies.
Index such as an example, the Standard & Poor's 500 index, which is going to track the 500 largest companies in the United States.
Mutual funds that are actively managed has an investment manager that is selecting the funds that make the list.
Let's go even simpler for guys like me. When you say indexed, they're indexed and they're passively managed.
So index, there's no one running the show. It's just a set list of,
so they pick, I'm making these up, they pick.
The S&P 500. There's 500.
The only thing running the show is the investment company offering the index fund. It minimum at least needs to make sure that the fund is properly set up in the holdings, okay? And so the underlying positions and stocks within the index need to be correctly matched up to the index. It's the basket of stocks it's attempting to track. And so there is that component of management, quote unquote management to it, but that's really where it ends in terms of the setup.
Companies, the largest U.S. companies.
And if they go up, then the index fund goes up. And if they just all go down, then the index fund kind of goes down. And over time, we hope these companies just keep getting bigger.
And just a note on the active side, on the active mutual fund, there are guardrails and parameters and limitations into what that active fund manager, where we have a professional team of investment professionals who have extensive education and background in investment management, are going to be on the investment management teams of these mutual funds. They are limited to a certain amount of things that they can use, okay? So if it, as an example, if we're investing into an actively managed US growth mutual fund, okay? It's going to have some percentage, usually a lot, in this case, a large percentage, something like 80 or 90% of the fund must invest into large cap growth-based US stocks, okay? And so they can pick within that parameter. They're actively choosing options within that basket, but they are limited to those baskets.
Growing, and then can companies fall off the S&P 500 and new ones pop in?
Yes.
So the whole thing should be just going up over time.
Exactly.
And so index funds means nobody's driving, it's just following whatever.
It's the autonomous vehicle of the investing world.
Ooh.
You like that?
You just ruined it
John,
for people.
I know. There we go.
Excellent. Okay.
So is that a good summary, Matt? Because you know about this stuff just as much as we do.
Yeah. And,
okay.
One thing that's sort of important to note is that mutual funds sort of have built-in fees, right? You know what I mean?
Correct.
There's built-in fees.
There's an investment manager. There's people to pay because this is their job to run these. Exactly. Yeah. So they do have fees. The perks of the index funds, as you know, diversification, which mutual funds have, low expense ratios, which index funds have, and predictability. And every investing rose has its thorn. For starters, your index funds won't beat the market because it represents the market. Does that make sense? So you'll settle for the average of the market. Yeah. You can never beat it. The goal of the mutual fund is that investment manager is hand-selecting funds based on tons and tons of research that they're doing every day, day in and day out, in order to attempt to beat it. So let's say the market does 10%. Well, the goal of the mutual fund is to do 12% or 14%. Now, as we know, they won't hit that goal every year. We don't have a crystal ball. We can agree on that?
Do you look for specifics in a mutual fund to try to hit those funds? Because I know 80% of mutual funds don't beat the market.
No, that's actually factually incorrect. Morningstar did this article, and they said nearly 57% of mutual funds, these active U.S. equity funds, they beat the average index fund peer over the 12 months through June 2023. So that means 6 out of 10 mutual funds beat the index.
Wait, over how long?
Over a 12-month period.
1 year.
They looked at, here's what mutual funds did, here's what the peer index fund did. 6 out of 10 beat the index fund.
Yeah, this is just over, keep in mind, he's talking about over a 1 year period of time, which when we're talking about long-term investing in stocks is nothing, is a very short period of time, and really not anything that's gonna give us a whole lot of good information. We need to be looking out over 15 years. And if we do, in this case, what we're gonna find is that the passively managed or the passive index funds end up outperforming the active funds on the larger end. And so just a note there.
Right, but why are you looking at a 12-month period versus decades?
You can look at decades, and it's going to change depending on the decade you look at. And the truth is there's going to be mutual funds that don't beat the index.
No, disagree. I think if we look at lots of different rolling 15 and 20 year periods of time, I think we're going to end up having the same conclusion, which is the index funds, if just held, would end up outperforming the mutual funds when we factor in the cost difference.
Index, and there's going to be years the index beats the mutual funds. And so the goal here is to slightly beat the copycat of the stock market, which is the index fund. And so the index funds also do have a fee. You'll see it listed as a 12B1 fee. And so that kind of makes up for the fact that the mutual fund fees there. So it's not exactly free. And here's the thing, we're not anti-index funds. There's a time and place. In fact, Dave Ramsey invests in index funds outside of retirement. You have that taxable brokerage account, right?
Yeah.
Dave would say index funds are the smart play there because of the low turnover. They're not moving things around as much, which makes the fees less. But in retirement, you're not having to pay those fees because you're not worried about turnover because this is a long-term play. And therefore, he invests in mutual funds for his retirement accounts, index funds outside of retirement. So there's a time and place for both.
What do you look for in a mutual fund, though?
That's a good planning note. From a purely a tax standpoint, I agree with all of that. Certainly you would want to have something with high turnover, something that's going to create more taxable income and dividends to be in a IRA or a retirement account for tax purposes, because it's tax deferred. Whereas of course the index funds otherwise. So just purely from a tax standpoint, I think that's great. What that's referring to is a strategy named asset location. Okay, so much of our conversations around investments centers around asset allocation. This is referring to the concept of asset location.
Mutual fund, though.
Well, there's a lot of pieces of it, including rate of return, the expense ratio, what the fund is made up of, who the fund manager is. Have they switched the investment team recently? If it's been doing great for 30 years and all of a sudden they switch the crew, well, that's something you want to look out for because things might change. And we actually covered this in depth, Matt, in our Investing Essentials live stream. And it's not currently available, but just for you, I'm going to send you a link to watch that for free. How's that sound?
Good. But isn't that sort of...
Just a note on an investment management team regarding actively managed mutual funds. I've been in the financial services business nearly 20 years. I've probably seen a presentation or some sort of sales pitch from 50 or maybe even 100 different mutual fund companies. And let me just say this, everybody has the most amazing investment team of talent put together you've ever heard of, okay? So I say that to note that the market is totally flooded with amazing investment team stories and conversations that you can have with these funds. And so I think it would be a difficult process for the average investor to go out there to the marketplace and say, hey, I want to find a really good investment management team. I think that would be a very, very difficult task to do.
Inevitable? I mean, if a mutual fund has a 30-year history with one manager and I'm 21 and I want to invest for another 30 years, isn't there pretty much a guarantee that the fund manager is going to change, the fund management team?
sure, over time, things may change, but what we're looking for is that longer term track record. And so we're not going to choose a fund that's been around for a year. We prefer the one that has a track record of 10 or 15 that's had the same team with the same record of success.
But dude, that's like saying I don't want to root for the Yankees or the Astros because they're going to have different players in a few years. The goal is you hope that they have guiding principles and they have the same desire to win and they have the same integrity over time. Some teams are better at integrity than others with the teams I just labeled. I know Kelly's looking at me, not the
Kelly's
Astros.
upset.
But you see what I'm saying? Like, yeah, the fund manager's going to roll over, but it will change over time.
Matt, here's the deal. We can argue all day and I can tell you like this, but you can be a multimillionaire just from your index funds. You don't have to ever touch a mutual fund if you don't.
I'd agree with that as well. And so we'll stop the video right there. And in conclusion, really the idea is in my view, index funds versus actively managed. If you're a do-it-yourselfer and you're building your own portfolios, and we just want to go with something that is going to give us better diversification, and we're not quite out there picking and choosing different funds, then just go with a blend. Go with half into active funds and then half into passive funds. However, when I build portfolios for clients, I typically will use index-based ETF funds that we then apply an active management through rebalancing strategy to. And that's for a whole nother video. But I hope you enjoyed this one. I hope there's some great information in here regarding how to set up our investments in 2025. Thank you so much for tuning in. Please like and subscribe. And I just can't thank all the viewers enough for the support and the outpouring. It's just been awesome. And I will see you in the next video. Thank you so much.